We have Vikas Pershad, Portfolio Manager at M&G Investments, joining us, I presume, all the way from Singapore. Vikas, is that where you are at currently?
Hi, good morning. Yes, concluding the year at home. I'm here.
Okay, fair call. Vikas, good having you. Thanks so much for joining in. Niraj here. Let's start by thinking of how are you looking at 2025 as a year? Is it a year that belongs to a certain set of markets like the US, or could it belong to the emerging markets? And then we'll move on to what within that landscape may or may not look attractive.
It's hard year to year to see or to think which year will belong to which markets. However, what we've seen for 2 decades now is that India and the US have led equity returns around the world. I think on a perspective 3, 4, 5-year view, that should remain the case. Now in the US in particular, we've seen a material re-rating and we've seen a very narrow rally. What's healthier about India is that heading into the end of the year, we've seen a bit of a de-rating. And part of that was justified. The September quarter earnings were not as good as expectations. But when we look forward, it's normal to reflect. Every year for the past few years, I've gone through the same exercise. Is this the year the Nifty streak ends? Is this the year India disappoints on equity returns? In September, I thought the probability was higher that that would happen, but the case for Indian equities still looks good in a regional context, in an emerging market context. Also, our view remains that as an equity market, India no longer is an emerging market. We think it has emerged. How much more does it need to emerge? $5 trillion market cap, massive economy, rapidly growing, busiest IPO market in the world. And so I think that from here, the case for Indian equities remains pretty constructive, and we are positioned accordingly. We are fully deployed in India. We've been active on the ECM front, but we have a lot of core holdings as well that continue to perform well.
Because what are you making of Trump 2.0? What does it mean for American markets? And what sort of an implication can it have for Indian markets? Because from what we understand is that there could be some inflation based on, in anticipation of the policies that he has in store. We've already started seeing yields harden, the US 10-year yield specifically. What does that mean for the US markets? And do you think that there could be some fund flows coming back to India based on that?
So this is an interesting question, and let's look at it in parallel with the China and US dynamic and what that implies for Chinese equities also. That's another market where we are constructive. That's another market where we have allocated more capital this year. The difference is in 2016, when Trump 1.0 kicked off, Chinese companies were not really ready for what came. They are now much smaller, leaner, better allocators of capital. And the relationship between Xi Jinping and Trump might evolve. Xi Jinping was invited to Trump's inauguration. Now, conversely, you look at India, and Trump 1.0 was better than Trump 2.0 might be. That's what we're prepared for. We are widening out our earning scenarios. We're widening out the tariff and revenue growth scenarios for companies that are particularly exposed to the new policies that will come out of the White House. So we might see a difference. Chinese companies might be better prepared this time around. Indian companies might have some surprises in store for them. Now, India broadly is very important to the US. And so that will be taken into consideration as the new administration crafts policies. But you're right, this is the right thing to be focused on. And I suspect that there will be some surprises along the way in 2025. We've already seen that. If you look at the automotive parts companies that have facilities in Mexico, as an example, we've seen some volatility in those share prices. We've seen some deratings in those share prices. That probably continues at least for the first half of the year.
Okay, because the other aspect is that there are large sectors in India which haven't quite done as well as their fundamental performance has been, particularly banks, for example, right? Because there's this incessant FI selling that has been continuous in Indian markets for the last 6-7 months. So there is a technical element to it as well. And you can sense it because fundamentally the performance hasn't been that bad, if you will, or has been reasonably okay in certain cases. Could we see that selling ebb at some point of time if indeed there is no rate hike trajectory in the US, or if rates stay constant, if you will, and if the dollar strength were to just kind of cool off a little bit, if you will? And can that help fundamentals meet valuations in case of banks. A lot of banks, private sector banks, available 1.5 times FY26, FY27 book valuations as the case may be. Is this attractive enough, or would you rather fish in different ponds?
Well, there's a few things to unpack here. First, I agree with you that if you look at financials, which is a very broad universe, as you know, if we focus on private sector banks, we feel that there are opportunities there. That's the one part of that broader financials area that we are overweight. If you look at this year and the names that have underperformed materially, hydrocarbons, those companies, especially in the second half of the year, the consumer staples companies throughout the year, but especially post-elections, that initial bump that we saw when people were assuming that there might be some more socialist policies. In Q4, we've seen that as the tide has gone out post-earnings, these companies have not been prepared for that. Now, when you come to the banks, this is such a large, diverse universe. We remain zero weight or materially underweight the microfinance institutions, many of the consumer finance names. We're beginning to see some stresses there that weren't there at the beginning of the year. Now, microfinance has been dealing with issues all year long. Then you layer on top of that the regulatory pressures, and we feel that you have to be even more selective than you are in other spaces. A, because there's so many more choices, but B, because the earnings outlook varies a great deal from bank to bank, from sector to sector within financials. But private sector banks here, I agree there's an opportunity. If you remember what happened to the largest private sector bank in Q1, material underperformance, but look at it since then. And people who kept the faith there in the management team, in the broader outlook, and just looked at the valuation, realized that there was a disconnect here. It has changed in this 40% or so rally from the lows, but its peers continue to be positioned well, we think.
Vikas, tell us about emerging ideas that you guys are spotting or you guys are doing work around for now when it comes to India.
Well, so we start with cooling. If you look at the air conditioning names, this is a sector where we increased our positioning materially in the first half of the year. And as we head into the end of the year and we look at next year and you look at names that have outperformed, it's natural to think that maybe this is the time to take profits. But if you look on our time horizon, 3, 5, 7 years out and beyond, India cannot achieve the economic goals that it has. The people cannot achieve the productivity levels that they need without massive deployment and penetration of industrial and home-based cooling. So the air conditioners are a natural place to start. But then if you look at the derivatives of that, the companies that are manufacturing these, the outsourced manufacturers, there are opportunities there. Now, those companies have re-rated even more than the air conditioner OEMs, but we continue to like that. We continue to be overweight that space, even here, despite the performance. Again, this is a very long-term theme. If you're looking for long-term investments, you will find them here. So that's one. Before I get to the rest, I'll also say, what have we not changed about what we don't like? Consumer staples, I mentioned earlier. We own fewer consumer staples names today, heading into 2025, than we ever have. And most of those are zero weights. They're not even underweights. And so we have a very selective exposure to that sector. I don't see that changing anytime. If you broaden out the consumer exposure, paints, yes, they've underperformed, but the earnings cuts have been material. And for the first time, we've seen material deratings rather than a re-rating, or at least holding the multiple, because what the market is implying, or what the current share prices are implying, is that there's more pain to come. Now, to come back to what we do like, the auto derivatives, auto parts, that still seems interesting. Hospital, life sciences, healthcare broadly defined, we still like that. Pharma has done very, very well for 2 consecutive years. Hospitals have done very well for 2 consecutive years. Again, doing your homework, being selective, still yields opportunities there. I'll mention one last thing, which is exposure to the luxury spending theme. When I moved to Asia 20 years ago, in 2005, everything was all about the bottom of the pyramid. Harvard was writing case studies about small little sachets and the penetration and distribution. We've seen that narrative invert, and we still see a lot of opportunities heading into the end of the year and into 2025 at the very top of the pyramid. And that's where our portfolio is allocated as well. I'm happy to go into some more detail, or we can talk about other sectors as well.
Yeah, I mean, no, some detail is welcome, Vikas, there. And then we'll talk about the other sectors too. Just trying to couple in this point that when, you know, when you are looking at taking positions now in this market, are you elongating the time frames for the returns? Because hitherto the market was buying and people met their internal targets way earlier because of the gush of liquidity. Do people need to reallocate or rethink their timelines?
Yes. Okay. So this is a great question. But when we invest in a company, the intention is that our holding period will be in perpetuity, that it will be indefinite. However, when we evaluate our portfolios, we realize and we recognize that we buy our portfolios every day. We are underwriting our portfolio every day. So we are focused on prospective returns each morning when the market opens, each day when it closes. And that calls for some reallocation of capital. What companies have done as well as they have, when you've seen the inflow of new opportunities to the extent that we have. 5 years ago, I was just looking at this over the weekend. In 2020, we had maybe 30, 40 IPOs. This year, we've had over 300. I would be surprised if we materially exceed that number next year. But if you look at the investable universe in India, it has now grown to 6,000 companies. There are about 1,600 companies with a market cap over $100 million now. So when you have so many new opportunities and you have material outperformance of India relative to other markets, and then within that, the leaders, the breadth that we've seen, and the material outperformance of leaders in their sectors, then yes, it calls for a reallocation of capital. I mentioned a couple of themes earlier that we are not taking profits from. In fact, we've added in Q4, cooling being one of them. But yes, we don't hold with a particular time horizon. It's just indefinite. But because we're focused on prospective returns in this market, we probably have traded a little bit more this year, our last 18 months, I would say, than we have in previous years.
Okay. Because did I hear you, just last question from mine, did I hear you say hospitality? And I'm just wondering, the new listing today, ITC hotels business getting demerged, a lot of builders thinking of a hospitality portfolio of their own, Prestige, Oberoi, etc., and the listed players talking about very strong growth. Is this a sector that is good to keep in the portfolio?
Yes, I had mentioned hospitals, but I'm glad you mentioned hospitality because that is in our portfolio also. There are some benchmark names that we hold. There is some off-benchmark exposure as well. And this is yet another space like hospitals, actually, where you've seen a lot more choice on offer in the past 2-3 years through the public market listings that we've seen compared to years before. Yes, this is also part of the Lux theme that I mentioned. I talked about there's the obvious area to talk about, which is high-end real estate. But hospitals are part of that. Hospitality is a part of that. Airlines are a part of that. There are many ways to express this view that wealth is becoming more concentrated. And what the implications are for society, that's a different and longer conversation. But when it comes to investing opportunities, we continue to think that this is not a fad. This K-shaped recovery that we saw coming out of COVID has become indeed a K-shaped economy. And we continue to see opportunities there, and hospitality is a key part of that.
Vikas, we leave it at that. Thank you so much for joining us and giving us your perspective on Indian markets, how things could potentially pan out in all the stocks that you are looking towards and interested in, and of course those that you look less favorably towards.